brief word about our speaker today, Joel Sinkin. Joel is the president of Transition Advisors, LLC. It's a firm that exclusively consults on growth and succession strategies using mergers and acquisitions for CPA firms. Mr. Sinkin is an expert in practice evaluation, succession planning, and transaction structure. He often consults on internal and external succession planning and provides complete transaction support to his client firms. And Joel has consistently been named one of the top 100 most influential people in accounting by Accounting Today. So before I turn it over to Joel, I'd like to go ahead and launch our first poll question. And attendees, you should be the poll question in front of you right now. Okay, sorry about that. You should be seeing the poll questions in front of you right now. And so the poll question is, how many partners are in your firm? And the choices are 1, 2 to 4, 5 to 9, 10 to 19, or 20 or more. So please go ahead and select the option that best represents your firm. Remember to click the submit button at the bottom. And just a reminder that voting in each of the 3 poll questions is required in order to earn CP credit today. Yeah. And so the majority of you have already voted here. We'll take about 10 more seconds if anyone has not gotten their vote in yet. Okay, going once, going twice, and we'll go ahead and close that. And Joel, welcome aboard. It looks like 71% of our firm attendees today are in 1 partner firms, and another 22% have 2 to 4 partners.
Wonderful.
All right, Joel, and I've just given control over to you, so you should see the prompt in just a second here.
I do not have it yet. I still don't have it.
Yeah, take a look and see if you've got a prompt underneath your PowerPoint window, maybe. I can just double check it here.
Nope.
Okay, I'll bring it back to me for a second and then give it back to you again.
There we go. That time it worked.
Okay.
All right, thank you very much, and welcome everybody. I want to make a quick comment on that polling question. It's very comparable to what the makeup of CPA firms are. The AICPA has over 50,000 firms that are members of the AICPA. The vast majority, 33,000 of them, are sole practitioners. Remember, you have the top 100, which brings you to about 35 million. Then you have the G400, which brings you down to about 10 million. Then you have the other 44,500 accounting firms. So we're kind of very representative of that. Today we're going to focus on succession planning. When do you start the process? How do you structure the deal? How do you choose a successor? What do you look for in due diligence? What do you do to maximize client retention? And we're trying to give a perspective of both if I'm the one looking to reduce my time commitment and looking for the succession plan, and information if I'm the successor firm. There's a lot of information we're going to share. So I'm going to be a little bit of a 33 record on 78 to get through it quickly. If you don't know what that means, you don't have to worry about succession. But I'm hopeful to leave some time to address questions at the end of the presentation. And as Div said, if we don't get to yours, we will email you a response to your question. I don't ever like to make a CPE class into an infomercial, but I think it's important to have the perspective of the speaker. And the only thing I'm going to say to you is, the last 27 years, the only thing that we've done is help accounting firms buy, sell, and merge with each other, ownership agreements, things related to that. But I've been involved in over 800 closings of accounting firms over these almost 3 decades, ranging from some of the largest deals of the top 100 to sole practitioners. And fortunately, you're speaking to me in 2017 as opposed to 1990. We've made a lot of mistakes. We see people make mistakes. You try not to make the same mistake twice. So I guess in a way, the sillier you are, the smarter you become. So hopefully today we can help you avoid some of the potholes that we tripped up over. One thing that I do want to make clear, and I always say this at the beginning of almost every one of the sessions I teach or the articles and books I've written, is if there's 50 things you need to know about a succession plan in this case, the smartest person in the room is only going to think of 35. And we're just not going to get you to 50 today. Accounting firms are so unique. I could take 5 accounting firms doing the same volume with the same amount of owners and the same amount of staff, and there may be nothing else the same about them. So the uniqueness of an accounting firm will require you to go beyond the list of things that we'll be discussing now and in future CPE classes. But we'll hopefully get you beyond that 35 number into the 40s. I think one of the things we should start with is trying to get our arms around what's going on out there. I mean, there isn't, I write for Accounting Today, the CPA Journal, Journal of Accountancy, and there isn't one of those publications that come out that doesn't have something about mergers and acquisitions of accounting firms. Matter of fact, every year there seems to be a record of how many actual closings took place as opposed to the prior year. And what's going on out there? Why is the activity so significant? Part of it's an economy-driven thing. For example, in 2006 through 2008, people were growing organically so significantly that the idea of needing to acquire a firm was not as significant. In 2009, business started to be very challenging, and as developing new clients, let alone retaining your current clients, became more challenging, acquiring a firm became a stronger alternative. But now in 2017, a lot of people are confused where they are because everybody has a different perspective. The one thing that we all do seem to have in common is a very dedicated effort to recruit, retain, and train staff. The staffing shortage is very abundant. What most people don't realize is that that does have an impact in the M&A world, but we'll talk about it in a minute. But whether the economy is getting better or worse, it depends who you talk to. But certainly M&A in 2016 was greater than it was in the year before and consistently for many years. There are 3 main drivers of the M&A activity in 2017. The first one is niche development. When you think back in 1990, for example, when I first started, most accounting firms weren't having all these voluminous amount of niche services. Now you have IT consulting and wealth management and forensic accounting and business valuations. And what we're trying to do as a profession is get away from the nuts and bolts service and come to the value-added services of being their most trusted advisor, and not just doing their tax and accounting and bookkeeping types of functions, but to bring consulting services to it. So niche development has created a lot of action in the accounting M&A world. For example, if I have a high net worth individual firm and you have a firm that does a lot of wealth management, estate, and trust work, it's a natural thing for us to potentially talk about a merger and create a cross-selling opportunities. So whether I'm acquiring a niche, whether I'm acquiring a firm to cross-sell or merge with a firm to cross-sell, certainly an activity. I'll skip the boomers for a moment. And the IT has also changed the world of M&A. It used to be people were very hesitant to have a satellite office. They always wanted to have everybody under one roof from a cultural perspective, from an overhead perspective. But technology has changed so much of that. The amount of time we visit our clients has changed, and we'll talk more about that in a moment. But what's happened with IT is what you're able to create satellite offices but still have synergies. We recently closed a deal in New York that acquired a Florida firm. And when you call the 954 area code that firm was in Florida, it rings in New York. And just as easily as you hit extension 125 and switch it to someone in that roof, they could switch it to someone in the Florida office. As a result, they didn't need as much clerical people answering the phone. They did all the billing and processing out of one office. They shuttled all the work on the cloud from one office to the other. So IT has created an environment that makes it mergers and acquisitions, especially of satellite offices, more simple. Matter of fact, if you've noticed, most of the top 100 mergers in the last few years have been entering new marketplaces, and IT has something to do with that. But by far and away, the overwhelming incentive behind most deals relates to succession and the baby boomers. We're at a time right now where we're having some of the largest exodus we've ever had in the profession, where over 60% of equity owners in firms today are over 55 years old. Of the members of the AICPA, 64% will be eligible for retirement by 2022. So we're facing the greatest exodus of talent we have ever had, and at the same time challenged by having some of the smallest crop of new CPAs that have come into our profession. So the numbers are becoming very overwhelming. But certainly the baby boomers' need to plan for their succession is an overwhelmingly strong factor in the M&A activity. The one thing that will always keep the M&A world very focused is that as an accounting firm, we're always limited to 3 ways to grow, or main ways, I should say. One is one client at a time. In a good economy, that works. In a bad economy, maybe it keeps you up with your attrition rate. Now, in the last few years especially, we see people developing marketable niches to cross-sell services, to penetrate our clients, to provide more services, generating more revenues, and, by the way, more loyalty. But by far and away, the fastest way to grow is still through a merger or an acquisition. So that also is part of the steam that's piling up in the marketplace. I think the place that most people don't always start, but should start, is when do you plan your succession? When should you start to make that plan? And before reviewing the information on this slide, let me start with a premise that's especially true for the smaller firms. 99% of your clients have no idea if you're competent or incompetent, because if they knew that much to measure your technical skills, they'd surely be doing the work by themselves. Unless there's an audit involved or a test that they can't sign for themselves, how do they, if they really knew what they were doing, would they be paying you the fees they pay you? So why do you have your clients? It's blind faith to a certain degree. You're their most trusted business advisor. They may not have a yardstick to measure your skills, but they know who they trust. They know who they feel comfortable with. I mean, I hear it all the time. What a great accountant I have. You should see the refund I get. Well, maybe you'll go to jail if you get audited. Maybe the government shouldn't have your money all year interest-free. We know there's 100 different ways to look at that. But this is what your client base is. So why do you have your clients? It's because of you. And the smaller the firm, the more likely your firm is partner loyal. You know, if I'm a client of PwC, it's very likely I'm firm loyal. I might be there because the bank wanted me to be at that firm. There could be a lot of reasons. But if a partner retires, they put another partner in, and I'm probably not going anywhere because I'm there to be part of PwC. But as a sole practitioner or even a 10-partner firm, for the most part, your clients aren't brand loyal, they're partner loyal. So how do you deal with this? The answer is somewhat slowly in a perfect world. So the first thing I ask someone is, how many more tax seasons do you want to work full time? See, too many people think about when they're going to retire. Very few practitioners and owners go from working full time to retirement. Most of them want to slow down. So the first question I ask people is, how many more tax seasons do you want to work full time before you reduce your time commitment to the firm? Now let me tell you the reason I asked that question. You know, 27 years ago when I started, Most of the firms I worked with, they went out every month or quarter to see their clients. Heck of a lot of them did the work there, wrote their check, the client signed it, and they left. But now we're in 2017. And while we communicate with our clients more than we ever have in the past, how are those communications? They're through the cloud. If you're not on the cloud, you should be, and you should get a hold of Accountants World to help you get it done. It's through email. It's through phone. It's through fax. It's staff going out. But there was a statistic in the Accounting Today a couple of months back that 87% of accounting clients are only in the same room with the owner of the firm or the partner they deal with once a year. They may be on the phone, email, whatever, but in the same room once a year. So when someone says to me, I'm 3 years from slowing down, it sounds like an eternity. To me, that's only 3 visits. And the 13th Amendment prevents slavery. You can't buy and sell people. So you need a proper transition plan so that by the time you do reduce your time commitment, it's a non-event. The transition's been done. The clients are comfortable and warm and fuzzy with the successor firm. So we have to tie in how often we see the clients in FaceTime, not how often we speak to them on the phone. Can't really transition people on the phone. Right? How often do we see them? If you have one of those rare practices that you're in front of all your clients, 4, 5, 6 times a year, the only tax returns you do are those business clients, yes, you could do a transition in a much shorter period of time. But if you're like most, you need at least 2 years in advance before you're going to slow down. Add another year to find the right successor and structure the deal. You're looking at at least 3, and I even prefer more. Now, there are other things that impact the timing of starting a transition that not enough people think about. Sometimes you lose a critical staff, and instead of desperately trying to find someone to train, replace, and everything else, maybe now's the time to merge with a successor who will fill that void for you and start the transition. But one of my pet peeves is about location and leases. I get this type of call all the time. The one I'm about to describe to you came from a firm in Texas just this week. A gentleman called me up. He said, Joel, we're a 2-partner firm. We're doing about $1.8 million. And both of us are looking to slow down over the next 3 to 5 years. And we read some of the articles you wrote. We wanted to talk to you about a succession plan. And part of his description was, and by the way, we have a beautiful office with beautiful, well-appointed space, great location, reasonable rent. Matter of fact, we just signed a 10-year lease extension. So I said to this gentleman, Henry, let me ask you a question. If you're the size you are, how big of a successor firm do you think you're going to need? He said, probably 3 to 10 million. I said, I agree with you. I said, don't you think they have an office? What this gentleman did by just extending his lease was he put himself in a position of weakness, because now the only people who are going to take over that lease is someone who's not in the area who wants to be. If you have a real small firm, it may not be big enough to justify a satellite office, or someone who just happens to have a lease ending by coincidence, or someone willing to have a second office, but no doubt because of the additional costs of having that second office, they're going to reduce the offer they make to Henry and his partner because of that. If they could have moved under one roof and created more synergies, it would have been more profitable, and as a result, the buyer could have afforded to pay the seller more and make more money. So be careful about investing into such things and signing obligations and leases that next people are going to have to deal with. Put yourself in a position of flexibility. Start the process early. Now, when you go to choose your successor, there's certain questions you need to think about. First question I'd always have is, why do you want to do a merger to the potential successor firm? Sometimes you hear a great answer. We've got a lot of great staff. We want to promote them to be partners. We have some excess capacity. These are great answers. A terrible answer is, well, we have a lot of extra space, and I figured if I moved you in, I would reduce my overhead. If all what someone's trying to do is reduce their overhead, they can sublet space and accomplish the same thing, especially if it's a merger. We tend to spend more waking time with our partners than our spouses. So if the only person someone's coming together is to reduce overhead, that's a terrible reason. So what is the reason? Do they have capacity? Do they have capacity on a professional level, a staffing level, a space? Does their technology work? Because if you're way more advanced in the IT world than they are, It's going to be hard to take a step backwards. Are you going to, someone who's selling, who's on the cloud, is paperless, multi-screens, is not going to be comfortable with a firm who isn't there? Do they have the financial wherewithal to do this? Remember something, bigger is not always better. Better is better. Now, I will say most of the time the successor firm is going to be 2 to 5 times your size. But there are times where it doesn't make sense. Another example is I got a call from someone in California today with a small $500,000, $600,000 practice who was wanted us to consult with them, but wanted to identify $10 to $20 million firms. I said, why? And his answer was, I want to be secure that they're not going anywhere and they have deep pockets. I said to him, let me ask you a question. Do you do a lot of hand-holding with your practice? He said, Joel, you can't believe it. I go to the bar mitzvahs and baptisms and weddings, and I'm friendly with all these people. I said, what's a typical client? He says $5,000 to $7,500 a year. I said, do you think a partner at a $20 million firm is going to spend time on that client like you do? And he realized bigger wasn't better for him. He needed a culture that made more sense. One of the first rules of thumb I say to someone, whether you're buying, selling, merging, or merger, is if you don't want to eat lunch with someone, don't do a deal with them. Now, this is critically important on a lot of levels. On a merger, it's obvious. We're spending all this time together. It's less obvious in a sale. But clients, for the most part, have a significant choice of who they're going to go to as their accounting firm. Staff have choices. The people that have chose you because they were comfortable with you. If I'm not comfortable with my successor, why would I think my clients and staff would be? Sometimes there's a specialty involved. Do they have the proper licenses? Do they have the knowledge? Do they have the capacity? How are they doing with retaining their own clients? Do the billing rates make sense? Location. I get asked a lot about location. How far could I move my practice to another firm? My answer to them is, let's say you weren't slowing down, merging, or selling, or looking for a succession plan, but your lease ended and you found beautiful, well-appointed space. How far could you move it and not worry about losing the clients? Well, that's how far you can move it to a successor. Because if you do a proper transition, as we'll talk about shortly, it's not the loss of you, it's going to be the gain of them. So we should be able to retain them. Another thing about location is if all your clients are on the cloud and everything's emailed in and the some that you do see you go out and visit, then your location is pretty irrelevant to your clients. Maybe relevant to your staff, but not relevant to your clients. If everybody comes to your office to be serviced or dropped off, it's an issue. And of course, just as we talked about having capacity and chemistry, one of the third C's of the 4 C's that we'll talk about at the end is culture. Does the successor firm have a culture that makes sense? Do they have brand loyal clients or partner loyal? Are they a one-firm client, or do they operate under an eat what you kill? Will a partner be the contact person, or will they leverage it down to someone else? Who's doing the work's kind of less important, because that's behind the closed door. But who's touching them, and who's calling them, and who's their go-to person? That's important. You know, I've been involved in, as I said, over 800 closings of accounting firms, and not one of them has the successor firm not done a good due diligence on the firm they were absorbing. But how rare it is that the firm merging up does any due diligence on the successor firm. At least do a background financial check. They're robbing from Peter to pay Paul. You don't want to wake up one day being Peter. Some people are so politically correct they forget that some practices have a language or ethnic type of thing, or even gender. In the Midwest, I had a 4-partner firm, all owned by women, who's marketed themselves as women-owned practice for women-owned businesses. Well, you can't sell that practice to an all-male firm. So there are certain things that may not be politically correct, but they're reality. There are times where you have 2 people that aren't partners that are going to join together to buy your practice. That's what I refer to with longevity of partners. It's a bit of a red flag. It doesn't mean they can't work. It can work. But if 2 people have never been partners before, they've never been partners before. And being a partner is different than being a friend or a coworker. If I'm transitioning to a staff person, their track record is. But the 4th C, we talked about chemistry, we talked about capacity, we talked about culture, is continuity. Clients like the way your ship is sailing. Staff likes the way your ship is sailing. Someone's going to come in and make wholesale changes, that's a problem. And that's the wrong successor firm for you. As a successor firm, one of the things that people don't think enough about is what's that seller thinking about. And what I mean by that is These decisions for sellers is usually much more emotional than it is financial. I teach a lot of classes on how to value an accounting firm. Suffice it to say for now that nobody's going to buy your business to lose money. So you want to be paid well for your years of sweat equity, the buyer wants to make a living. But it's the emotional side. A lot of sellers feel, hey, I'm irreplaceable. If I retire, I'll die. My clients need me. I had recently, and I run into this a lot, someone who wanted to merge with someone for a couple of years to do a transition, but they didn't want the accountability, the master of their own domain. They didn't want to suddenly feel like a clock-punching employee. I don't mean any of these things as humorous. I mean them to understand and wear the shoes of someone who spent 40 years or more running their business and now are facing this ultimate decision. It is very emotional for them. But now we've come to making that decision. And we're going to talk about deal structure. But before we go too far in deal structure, Dib, why don't we do another polling question so they can make sure they get their CPE today?
Okay, sounds great, Joel. So I'm going to go ahead and load the second poll question right now. And so the second poll question, which you should see in front of you, is how many of your partners want to slow down within the next 5 years? None, less than 50%, more than 50%, or all. So please select one of those options and then remember to click the submit button to make sure your vote is counted. Looks like we're at about 80% of people having voted at this point, so we'll take a few more seconds and allow people to go ahead and get their vote in here. Just a reminder again, this is the second poll question. Voting in all 3 of the poll questions is required in order to earn CPE credit today. All right, we'll take about 5 more seconds here. Going once, going twice. Okay, Joel, so we see half of people said none planning to slow down within the next 5 years. Quarter said all, and then the remainder was split between less than 50 and more than 50%.
Okay, well, we got a lot of people who are looking at the reality of succession, and probably those that aren't are looking to be the successor. It's a wonderful combination. So let's talk about alternative deal structures for people looking for succession. Again, different than a straight merger. By the way, a lot of people will use the word sell and merge or buy and merge interchangeably. They're not interchangeable. If a merger means I'm exchanging equity or ownership in my firm for ownership in your firm. A sale means I'm not going to be an owner. So that's an important distinction. Of the 5 types of deal structures I wanted to address today, the first one we'll talk about is a straight sale. Straight sale is probably the second most often deal I do. It's where someone's not necessarily retiring and going to Florida tomorrow, but they don't want to work full-time anymore. Hopefully they're going to stay on in an of-counsel role to help you do a transition, but they're looking to sell their practice day one. A buy-in to buyout is a more unusual type. Here's an example. Let's say that as a seller, I have a $800,000 practice. As a buyer, you have a $200,000. We merge together the new firm's $1 million, but for you to have been a 50% equity owner, you needed $500,000. You only had $200,000, so you buy in $300,000, and then a couple of years later, you buy me out, a buy-in to a buyout. A merger to a buyout's a similar thing, except there's no buy-in from day one. So if we use the same example that the seller was $800,000, the buyer's $200,000, the new firm's $1 million, the buyer's a 20% equity owner, and then another year, 2, 3, or 4, they buy out the majority equity owner. An interesting trend that we're starting to see more and more is what I call a carve-out sale or a cull-out sale. There's a couple different types of them. One would be an example where someone had a niche, decided to keep the niche or sell the niche and keep the traditional practice. An example of that was very recently in the Washington, D.C. area. We had a firm doing about $1.6 million that also had a niche in wealth management. The gentleman loved the wealth management and got very unhappy being the accountant with the deadlines and everything else. But the accounting firm was the springboard that got them a lot of the wealth management clients. But what we ended up doing for him was we sold his practice to a firm that was filled with high net worth individuals and wasn't doing wealth management. He signed a non-compete on the accounting and compliance side. They signed a non-compete on the wealth management side. They literally moved in together, which offered a great deal of continuity. They held the deal out to the world as not a sale, but a merger. They said the seller of the accounting practice said to their clients, look, it's impossible for me to be on top of the day-to-day changes in the stock market and all the new tax regulations and requirements. So I've merged with Jane and John Doe. They're going to help me focus on the traditional accounting and tax side to free me up to do the wealth management for you. It was a call-out sale of expertise. So I've also seen some practitioners that wanted to slow down but didn't retire. Had a two-partner firm doing about $900 and some odd thousand in Florida last year. They decided to each keep $75,000 worth of clients. They weren't the best, they weren't the worst, they were their favorite clients that they've known for years. They sold the balance of the practice, they limited their non-compete to permit them to still handle these clients. Matter of fact, they even worked on those clients out of the buyer's office and gave the buyer the first right of refusal to buy them at a later date. So they sold the bulk of their practice, but they kept a little bit to keep them occupied. The last type of call-out sale I've seen people do is when they're out of capacity. Had a two-partner firm that wanted to look into an upstream merger. Wanted a succession plan, but didn't want to merge up. Right? One partner was 52, the other partner was 67, but the 52-year-old didn't have any capacity to replace the 67. They tried for years to recruit staff and develop staff, couldn't find anybody to take over, so they decided to cull out part of the practice to sell externally to handle the succession of one partner, and the other partner kept his. But by far and away, the most frequent deal that we're involved in is a two-stage deal. A two-stage deal came about because when I used to go around, I worked very closely with the AICPA, and I used to go around the country for them, teaching about succession planning and how 1 year is one visit, and you need more time, and you have time to transition clients, and everybody agreed with me, and nobody did it. Nobody merged with their successor in time to do a proper transition. At the end of the day, they didn't want the accountability of feeling like a small fish in a big sea. They were intimidated, and they didn't want to give up control. I'd have people say to me, Joel, if it's Thursday afternoon and I'm on top of my game and I want to play golf, I play golf. If it's Sunday and work has to be done, I do the work. But I don't want to go to a firm that's going to tell me what I have to do. As a result of this frustration of trying to come up with a program that enables people to do a transition but still maintain control, autonomy, and income, we came up with a two-stage deal. In a two-stage deal, stage one starts as follows. We take the practitioner who's looking to slow down, and let's use 3 years, that they want to work full-time for 3 years, then get out. We start by calculating their net, including perks, benefits, the kid's cell phone. So let's say, just for the purpose of this discussion, they're a sole practitioner, and their net's 40%, including everything. The next step we would do is calculate how much labor they used. So let's say, for argument's sake, this firm had one full-time CPA, one full-time bookkeeper, and an administrative person. So basically what we learned is they were making 40% based on using that much labor. Now, if I was in a bigger firm, instead of focusing on the labor they use, I'd focus on the chargeable hours that the owner was putting in. But since most of you are small firms, we'll stay with the labor thing. So we'd sit there and say, okay, John Doe's going to slow down in 3 years. Right now he's making 40% of what comes in from his clients, which will be an Exhibit A of the contract I'd ultimately prepare. And he makes his 40% using X amount of labor. So now we've created the criteria. What happens during this point in time is the successor firm says to this potential seller, hey, come in with me. I'm going to keep you whole in income by paying you the same 40% you were making now, but I'm going to take on all of the overhead. I'm going to pay the rent. I'm going to do all those things. And I will structure it as a consulting agreement, so this way I'm paying your entity as a consultant the same percentage you were making before. And this way your entity could continue to pay your car lease and your medical insurance and feed your retirement plans and do whatever you'd like to do. And I don't care if I'm not going to say to you, you have to work 1,000 hours, 2,000 hours, 3,000 hours, because that doesn't matter to me as the successor firm. But because I'm not paying you other than the 40%. What matters to me is how much labor you use. So if you need more labor than you used in the past and didn't do this deal, you'd have to pay for it. So if you merge with me and during stage one, you need more labor than you used in the past, I'm going to charge you a fee for it. If you don't, no problem. But it's the same as if you stayed on your own. So in this particular case, The seller gets to come and go as they saw fit. They still have tremendous autonomy control. They're making the same income. It's kind of like a practice continuation agreement on steroids, because God forbid something happened to this seller before year 3, we could accelerate to the buyout. It also gives the seller a protection of lost clients. For example, if this seller didn't do this deal and lost a $20,000 a year client, they'd lose $20,000 of income. Their rent, labor, everything else would be the same. Now they only lose 40%. Also, the successor firm is usually going to give them a lot more backup and support. They're usually going to take over some of the admin, HR, IT, billings, collections. So as the person who's slowing down over the next 3 years, I actually get to put in a lot of the things I don't even enjoy doing. The running of the practice gets taken away, so I have more time to spend on transitioning the relationship, developing more clients that I get paid, and having a better quality of life. And by doing this type of 3-year gradual transition, there should be higher client retention, which means I'm going to make more money, because most of the time my purchase price is going to be contingent to a degree on client retention. So from the seller's perspective, I'm holding income. I'm still master of my own domain. I'm running my practice. I have a built-in successor, and I'm not laying out any of the money. I no longer have the liability of ownership, because I'm not going to be an equity partner of the successor firm. I'll be held out as a partner, but not an equity partner. For the successor firm, they have a couple of advantages. One is they know at the end of year 3, in this particular example, they're going to get the advantage of the practice. The practice, actually, ownership gets transitioned day 1, but they don't get the advantage of the practice at the beginning, because the seller's still keeping most of the money. But usually there's some synergies. There's rent synergies, there's labor synergies, there's software, a practice. And that usually goes to the benefit of the successor firm. I mean, a great example of that was just a few months ago. I got a call from somebody up in New England, in the Boston area, and we were about to finalize a 2-stage deal. And the seller called me up and said, "Do you know that the buyer's saving $100,000 in overhead?" I said, "Yeah." He goes, "They're getting rid of one of my part-time clerical people. We had the same software. They're moving me into their space. I should get some of that." I said to him, "Mark, you got everything you wanted. You're making the same money. You're working less. You have backup support. You have succession. You got the value you were looking for. The fact they're making some money is why they're doing the deal. Don't take away their sense of urgency." And let's remember, during those 2 years, they're investing time into transition, integration. There's a lot of costs involved. So there has to be some advantage to the successor firm, and usually it's limited to synergies. Stage 1 terminates, in this example, at the end of month 36, and stage 2 begins. Stage 2 is the buyout. See, I cannot keep you whole in income and pay you for your equity at the same time. And if you ask me to do both at the same time, I'm going to pay you less than your practice is worth and less than your time is worth. But instead, by doing a 2-stage deal and deferring the purchase price to stage 2, I can be kept whole in income and still get a strong value for my practice. So in this particular case, at the end of year 3, earlier if there's a health issue or the seller decides to move the process along, the buyer can't say, "Hey, I just changed my mind, you got to be out in year 1. It's a contract. But once the stage 2 commences and stage 1 ends, that's when the buyout starts. If there's a retention period, which there is in 99% of the small deals at least, that's when the retention period will begin. It doesn't begin during stage 1, because during stage 1, you're still the chief cook and bottle washer. So the retention period commences on the onset of stage 2. Typically, the seller will still stay on at that point in time part-time. And most of the time, if the seller stays on part-time, we welcome it, and we work out a compensation formula. The most frequent one I use is 1/3 of what the seller's billed out for. You know, if I'm paying the seller 20 or 25% of collections for 5 years, as an example, to buy the practice, and I'm paying them 50% of what they're billed out for, basically they're getting 70 to 80% of every penny, every dollar that comes in. It doesn't make sense. 1/3 of what someone's billed out for works because most accounting firms want to triple labor. So if I'm paying the retired partner 1/3, I'm still tripling labor. Also, if I'm a partner, I'm coming back in, I'm working at the highest billing rates, so I'm getting 1/3 of the higher billing rates. And for the successor firm, I'm not paying for non-chargeable time. So that's one of the most frequent formulas, but there are times we come up with a per diem rate or something else. One of the interesting things about a 2-stage deal is how people deal with new business. See, at the onset of stage one, the seller will give me Exhibit A, the client list. What if the seller develops new business during stage one? It's usually handled one of three ways. Rarely, but sometimes it's automatically added into and treated as original client, full buyout. Sometimes it's used as a replacement client. So if I went into the deal at $1 million in stage one, and I lost $50,000 in the first year of stage one, but brought in $50,000 of new business, it gets treated as replacement clients. And other times the buyer says to the seller, look, you're operating under my brand. You're only going to be here another year. It doesn't make sense for you to take on the new client and then transition it to me. Just transition it to me day one. You don't have to do a thing, and I'll pay you 15% of collections for 3 years, some sort of reasonable compensation. Remember, a client you just picked up at the Rotary Club or church last night isn't equal value to a client you've had for 20 years. So during stage two, we start the buyout. It's a whole different class on how to value an accounting firm. Matter of fact, I'm teaching one tomorrow. But to give you the Reader's Digest, everybody wants to know what the multiple is. Always remember, the multiple is the effect. You need to focus on the cause. So how much cash up front, if any? How long is the retention period where if a client's fees go up or down of the base I acquired, does that impact the seller? How profitable is the transaction for the buyer? How long is the payout period? Then comes the multiple. So if I could absorb your practice into my infrastructure with no incremental increases in overhead, and I was paying you with no cash down, the whole payout period was a retention period, I might pay a premium. Maybe I'll pay, as an example of a recent deal I had, 20% of collections for 6 years, paid 1.2 times. If that same seller said, I want to be paid out in 4 years, whatever you do in the second year locks the purchase price, and I want 10%, in their marketplace, remember each part of the country has different marketplaces, in their marketplace they would have been lucky to get one time. If the same seller said, I want to get paid off in 3 years and I want a third up front, I want a 1-year guarantee and goodwill, I couldn't get them 67 cents on the dollar. The same seller said, I want all cash at closing, I couldn't get them 50 cents on the dollar. So you can't start with multiple because multiple is the effect. You have to value a practice as a package. Again, how much cash up front, if any? How long is the retention period that adjusts the purchase price? How profitable is the transaction? How long is the payout period? Then comes the multiple. Now, many firms, not as many on our horn today, but some, will have some partners who want an immediate sale, some partners who want to work for 5 years or less, and some partners who want to work 10, 20 more years, but didn't have the capacity to replace the others. If you learned what all those deal structures we just went through, you know how to handle that. So for example, I'm doing a deal right now in the Midwest. It's a 7-partner firm. They're doing $5 million. One partner wants to get out right away. So the successor firm's doing a buyout, a straight sale for them. 3 of the partners want to stay on for anywhere from 1 to 5 years. For each of them, we're doing a 2-stage deal. The rest of the partners want to stay on for 10 years or more. They're doing a merger. So this is a very great tool when you learn all these different alternative deal structures, because now you don't have to have a firm where all the partners are looking for the same thing. You could customize a deal between one successor firm, one seller or mergee, where each partner gets their own unique deal that achieves their personal goals. And we're not jamming everybody to have to sell or everybody to have to work forever. So having that flexibility, if you're a 2-partner firm or more and you're not both at the same sunset periods where you both want to retire at the same time or slow down at the same time, understanding all these alternative deal structures can enable you to be very creative in making a deal that customizes and achieves the goals of each individual firm. You know, everybody has different things they want to do about due diligence. What I want to talk about is a couple of general things. You have this list. I think one of the articles I gave you to look at that we've attached here is an article on what to look for in due diligence. But there's a couple things that people tend to make some mistakes on that that are counterintuitive that I wanted to point out. One of the things that people find interesting is a lot of people think, well, that firm's a larger firm. They must be worth more. Usually the smaller the firm, the higher the multiple, the larger the firm, the smaller the multiple. No, I'd rather get a lower multiple on 10 million than a big multiple on 100,000. But there's a reason for that. You know, if you're a $300,000 practice and you're in a densely populated part of the country, there's a lot of firms that can absorb you with no incremental increases in overhead. If you're $5 million, you probably need a firm from 10 to 500 million to be your successor. They're making a third themselves, a third labor, third overhead, third profit. There's going to be an enormous amount of increases in overhead. So a larger firm typically is going to get a longer payout period and a lower multiple. But I think one of the most misunderstood things that people make a big mistake about relates to billing rates and profit. You know, we look at a piece of paper and we say, oh, their partners are getting $200 an hour, that's a problem. It might be, and it may not be. So let me give you a great example. I had a deal in Florida a couple of years ago where two partners, they were two owners, they were the only CPAs in the firm. Everybody else were basically glorified bookkeepers. And there was a multi-million-dollar firm going to do a deal with them, and they called me up during due diligence and said, we have a problem. I said, what's that? They said, we just realized that these two owners are only getting $200 an hour. We get $300 an hour for partner time. I said, well, you just did the due diligence, not who's going to hold the client's hands, but in your firm, you have partners, non-equity partners, managers, seniors, juniors. Their firm, they have two CPA owners and a bunch of bookkeepers. In your larger firm, who would do the work that these two partners are doing? He said, well, almost all the work they do is what would be senior work in our firm. I said, so what's your seniors billing rate? They said $150 an hour. I said, I guess they're getting $200 now. See, they assumed because their partners were $200 an hour, of the seller, the buyer's partners all had to put in the same amount of time out. No, that's where leverage comes in. Sometimes technology, maybe my technology is more efficient than yours and it takes me less time and effort to derive the fees. As a result, the billing rates go up without raising the fee. I've also had the opposite happen. A couple years ago in California, there was a firm merging up, and when we got to due diligence, now the firm merging up, 25% of their revenues came from audits. It turned out during due diligence, they discovered that the mergee, or the firm merging up, had one partner handle the audits from beginning to end. The successor firm had a quality control process much more robust than that, needed two pair of eyes reviewing all that stuff. It would take them twice the time and effort to derive that fee. So that billing rate would have fallen in half. So you can't look at billing rates on a piece of paper and make a determination. You have to transpose what time and effort and what level staff will the successor firm be using on that. The same concept, generally speaking, applies to profitability. You know, when I talk about valuing the firm and I mention profitability, I'm referring to the buyer's profitability, not the seller's, because in most cases, the seller's profitability is meaningless. I'll give you an example. Let's say 5 years ago, I had a $300,000 practice. I operated out of my home. My wife, Kathy, answered the phone. What was my net? 85%. Then I decided to move into an office. Kathy didn't come with me. I hired an office manager. I decided to take Thursdays off to play golf and brought in the per diem, and now I'm only netting 40%. At which point in time was my practice worth more to you? As a buyer, it's irrelevant. The profitability of the deal for the buyer is what's going to matter. So if the seller's netting 20%, but you're going to be able to turn it into 40%, great. If the seller's netting 85%, but you're only going to net 40%, that's the reality of it. So your due diligence with billing rates and profit isn't now analyzing a piece of paper. Your due diligence is transposing the way they operate in their firm to what it's going to look like in your firm. If I'm a seller and I'm performing due diligence on the successor firm, I think one of the most important things they should be looking at is the successor firm's retention rates. If they can't retain their own clients, why would you think they're going to retain yours? If they've ever done a deal in the past, you got to look at that and see whether or not how that one went. How did they do with that one? You know, so if I'm a buyer, this is a list of some of the things I want to look at, but one of the most important things if I'm a buyer that I want to look at, which isn't on this list, is how long the sellers had their clients. Because the longer the seller or mergee has had their clients, the greater the loyalty. And the greater the loyalty, the more likely we could retain them. I know it's counterintuitive, but the more loyalty between an accounting firm owner and their client base, the easier it should be to retain them, as we'll discuss in a moment. Part of your due diligence, of course, is looking at the firm cultures, exposure issues, quality control issues. Sometimes the smaller firms' quality control process, as an example I just gave, isn't as robust as the sellers. Is it going to take us more time and effort? So you all have these handouts. I don't want to preach about something that's easy enough to read. I want to focus on one of the most important aspects of the deal, and this is what we're going to finish with today, and that is transition planning. The greatest measure of success of any deal is client retention, because then the seller's getting the most that they wanted to get, the buyer's making the most profit they're going to make. So how do we go about this? And remember what we said, the more loyal the client, the easier it is to retain. Well, what you have to do is start by understanding what are the potential fears a client has when they hear about a merger, right? So what are those client fears? Well, we'll talk about that, right? Even though some of that's on the next slide. The slides are more for CPE than for me. There's 4 fears that they're going to have. First one is the person I trust still there? The second one is it going to cost me more money? The third one is, am I going to now have to drive someplace out of the way to see my accountant? And for those that work with your staff, are the staff still going to be there? So we need to craft a message that overcomes these fears before they're even brought up. So we start by breaking down the client list into categories. The biggest clients, they're going to get a visit. The smallest clients are going to get a letter. And the clients in between are going to get a phone call. So we have to decide who gets what. Now the way that works is, let's say that we're going to make a phone call to a group of doctors. And let's say I'm selling my practice to Div. I'll call up that doctor. I'll say, Dr. Jones, I want to tell you that I've just worked out a deal where I'm merging with Div. I'm merging with him because he has tremendous expertise in the new Trump tax laws and the modern computerization of accounting, especially as it relates to the medical profession. I'll be remaining the principal in charge of you as a client. We're going to be operating under the same fee structure, even though I have all this more, but I'll be able to provide you more services. The same staff you're used to dealing with are part of our new combined dedicated team of professionals, and we remain geographically sensibly located here in New York. In the opening conversation, I took away all their fears. So I want to go into a transition plan emphasizing the gain, in this case, of Div, not the loss of me. And if I'm doing a 2-stage deal, I'm going to be there long enough to make that transition. Think of change, which scares everybody, in 2 ways. Change behind the door, change in front of the door. Change behind the door is, I was using Lacert, the successor firm's going to use CCH. Well, the staff may care, but no client cares what software you're using. Change in front of the door was, I used to bill you once a year. They do billing every time the work gets done, so they're probably going to bill you monthly. That's a change in front of the door. I was charging you $500 a month. Now it's going to be $800. That's a change in front of the door. Changes behind the door you can execute fairly quickly. Changes in front of the door, you want to do more gradually. So these are some of the keys to transition planning. Dealing with those 4 fears. Is the person I trust there? Is it going to cost me more money? Is the distance a problem? Is the staff there? And I'm not going to focus on change. I'm going to focus on addition. I'm going to focus on continuity. And these are critical factors. When you take advantage of people's loyalty in an ethical way, instead of fearing it, it could be great. The person who says, nobody can keep my clients if I'm not there, I'm going to keep every one of them. The person that loses a client for a $10 coupon and a penny saver, there's nothing I could do to keep. So loyalty is a good thing. Don't fear it. Covet it. Take advantage of it, but take advantage of it in an appropriate way. To finish up with a last thought, always focus on the 4 C's when you're doing a merger, acquisition, or sale. Is the chemistry right between us? Is there going to be continuity or wholesale changes? Do our cultures match up? Do they have the capacity to replace me when I slow down, and skill set, of course? Remember, a good deal is a fair deal. You need to be paid for your years of sweat equity. If you're selling, the buyer has to get a profit. And don't try and negotiate one part of the deal at a time. It's a package. If you have good IT, good talent, good clients, good metrics, you're going to have a better value. So keep that in mind. If you're struggling in those areas, be realistic in how you value the firm. So these are some of the things I wanted to share with you. If you're a member of the AICPA, you'll find on their Succession Planning Resource Center from the PCPS, there'll be a ton of tools for you there that will be very helpful. Stay tuned for so we can give you the last polling question and a couple more pieces of information. And thanks for your patience today and listening. And any questions that people sent in, I'll make sure we get you an answer as soon as I can. But I know we've run out of time, and I want to respect the time that you guys had for the session today. Div?
Great. Thank you so much, Joel, for all of your information today. You see Joel's contact information up there, transitionadvisors.com, jsinkin@transitionadvisors.com, as well as his phone number there. I'm going to go ahead and pull up the third poll question right now. Third poll question is, your firm's most likely succession plan looks like selling internally to my partners or staff, finding an external successor firm, no idea, or die at my desk. Hopefully not today. We want to make sure you get your CP. So please select one of those options and then click submit, and we'll make sure that your vote is counted there. This is the third and final of the poll questions. And just a reminder that the one other thing that is required in order to get CP, you've been here for an hour, you've answered the 3 poll questions, make sure to fill out the post-webinar survey. That will open up after you close out of the webinar window at the end of this webinar. So we'll take just 5 to 10 more seconds here. I see over 90% of people have already voted, so if you haven't yet, please go ahead and get your votes in. Okay, and Joel, I'll just quickly share here, actually a pretty even split between the first 3 options, selling internally, finding an external firm, or no idea.
Well, if I could leave with one thought. For any of you that your plan of succession is, I'm going to find a young person to groom to be my successor. With all due respect, that's more of a pipe dream today than reality. It's very hard to make a plan based on finding talent. Either you have the talent or you're going to find an external solution. Keep that in mind, because I wouldn't want you to go down a road that's highly unlikely to be successful, especially with the tremendous offers that young talent's getting from big firms right now. The greatest commodity in accounting is young talent. Thank you, Div.
Thank you. So Joel, there's a couple of questions that have come in, so I'll turn it over to you for that in just a second. And a reminder, if anybody else has any other questions, please go ahead and submit them. I want to thank everybody for attending today. Please remember to fill out the post-webinar survey to receive CP credit. And also, Accountants World is offering a brand new webinar. It's called the Value Building Webinar. Forget value billing, think value building. And what we're looking to do there is to show you that there's this common misperception that there's no way to increase your profits from seemingly commoditized services like tax and accounting and payroll. But we want to show you how you can make your practice more valuable and profitable from exactly those core services. So if you'd like to learn 5 tangible ways to build more value for your firm and be able to provide more value to your clients in those key core areas, make sure to attend our webinar. You can go to valuebuildingwebinar.com and sign up there for that webinar. So I want to thank you again for attending today. We look forward to seeing you at the next expert webinar, Randy Johnston, 3 weeks from today. If you haven't signed up yet, you can go to accountantsworld.com and you'll see the expert webinar series section on our homepage there. So thank you again to all the attendees. Thank you again to Joel. If you have any questions, you can go ahead and submit them. And otherwise, have a great rest of the day.
Thank you all.
So Joel, one question that's come in for those who are sticking around right now, is this a buyer's or a seller's marketplace right now?
Actually, it's based on a couple things. If you have a small practice and you're in a densely populated part of the country, then it's certainly very much a seller's marketplace. So if look at Nassau County, Long Island, there are 3,000 accounting firms in one place. If I've got a $400,000 practice, there's so many that could absorb that it's a seller's marketplace. But if I'm in 2 hours outside of Boise, Idaho, I might be in some of the most beautiful country there is. But there may be such a few amount of accountants in the area that supply and demand takes over. So if there's not a large audience for you, it's going to be a buyer's marketplace. So for a small firm in a densely populated part of the country, it's more of a seller's market. Small firm in a remote area, buyer's market. As you go up in revenue, it becomes more and more a buyer's marketplace. If you're a $10 million firm in Boston, there may only be 3, 4, or 5 local firms big enough to take you on. So as you go up in size, the amount of potential successors start to shrink. So that's where it also has become a buyer's marketplace.
Great. Another question here. What are partners paying other partners for their ownership interest?
Large firms have changed to compensation-based buyouts, where they'll typically look at your last 5 years' income on an accrual basis, take the 3 highest years, multiply that by something between 2 and 3 times, and pay that out over 10 years, usually like on a K1 plus capital. Smaller firms, some will do it based on comp, some will do it based on the book of business you manage, some will do it on equity, and most of those will do it with a multiple. So if I'm a 30% owner of a $1 million firm and the multiple's 1 time, I'm looking at $300,000. Multiples have come down substantially over the last few years. Most multiples for internal sales are between 0.5 and 1 time. Most of the payout periods are between 5 and 10 years. The challenging part of that is it's more, a lot of times when a partner retires, they retire at fixed compensation. For all of you that are 2, 3, 4 partner firms where each person runs their own book of business and nobody knows each other's clients, that's a real risk. And if you don't have a proper transition, then you should add a retention period. I'm actually teaching a class tomorrow, if you go to our website, that you could jump in on how to value an accounting firm, both when sold externally and when sold to partners.
Great. And just a reminder, Joel, or just a recap, your company's URL is transitionadvisors.com. Is that correct?
That is correct.
Okay, great. If anybody has any final questions, we can get those in right now. I know we're a few minutes over, so I want to respect the time that Joel said, but if you have any last questions, feel free to type those in. Thanks again for